Okay, it's Monday about noon, and the Dow's down about 9.5%. Not really a surprise. In addition, the banks are down anywhere from 13 to 15%. Again, not really a surprise. This is, as I said in my video that I put out this morning, this is going to be a bad stretch for the banks. They're getting hit from all angles. Low energy prices, so it's going to put some loans in jeopardy. There's not much liquidity in the market, meaning that if you put it this way, if you are unfortunate enough to have invested in any penny stocks and you're holding them in your portfolio, and you now decided it's time to dump them and get out of them, you're probably going to find there aren't any buyers for them. So that's lack of liquidity. And we have gotten used to in the stock markets that when I want to sell something, there's somebody always there to buy it. Well, that's not true today. If you have a junk bond and you're a corporation and you want to get rid of it, you've got to find somebody who wants to take on that risk. And they're going to discount it very far normally, but this is not normal times. There are companies that are finding there's nobody to buy their assets. That's why you're seeing, even when we're seeing a flight to safety, gold is going down, and that's because people have a need for liquidity, and they're selling whatever they have. This is why some very substantial stocks are dropping like a rock, because it's not a run on the bank yet, but certainly it's a run on the stock market. And so there's a lack of liquidity, and there's an aversion to risk. So sellers outnumber buyers, and thus we have a drop in the market. So that being understood, then what should you and I be doing? Well, hopefully you've been watching my videos for the last year, and for the last year I've been telling you to get to cash, because I had said, and it puzzles me that everybody's blaming this on the virus, and certainly it's what's brought it to the forefront, but the real issue is that you have debt that you cannot now service because you don't have the assets to cash in or to put up as collateral to service your debt. So your zombie companies are in a bind. Now, I saw an interview today with the financial officer of Uber, and he made an interesting comment. He indicated that we're not in a bad position because our debt doesn't roll over until 2023. So he's kind of alluding to the fact that maybe they have just a interest-only loan, or maybe they have a balloon loan they're paying nothing on it. I don't know. That's a pretty good package if that's what he has. But if he's in that position, as I say, that he doesn't have to be making any payments till 2023, well, he's clean. But there are other companies that aren't in that position. I find it interesting. If, again, you have followed me in the past, you know that I was a big supporter of Zillow. I'm in the real estate business. I believe Zillow is making a very strong move to displace the brokers, to disarrange the activity or the position of the agent. And their stock had been up to 65 no more than 30 days ago, right after they did their earnings. It's down to 29 today. What does that mean? And what does it mean relative to other stocks that are finding themselves in bad positions? I'm not sure, and I'm looking into what Zillow's cash position is and how long they can survive if this market stays down And is that going to affect real estate agents? Are they going to not be paying for Zillow's services or providing leads? I'm not sure. But what I am sure of, it makes them a real fine target. It makes them a target for a buyout. Now, my decision is, do I want to buy Zillow at such a depressed price, or would I rather and have them bought out, or would I rather buy who I think's going to buy them out? And in this case, that I believe there's only three people who really would have any interest, and that's Amazon, Google, and Apple. So what am I doing right now, and what should you be doing right now? I believe in what I'm doing. I've got a spreadsheet. I've been working on it this morning, and it's something I'm going to share with you when we do this. When I ask for your email address, I'm going to give you a link, and you're going to give me your email address, and I'm going to send you this spreadsheet. And what you're going to see on this spreadsheet is the series of stocks that I want to own a year from now. And what I'm now doing is saying, okay, they're down anywhere from their highs. They're down anywhere from, about 20 to 27% from their highs. What price? And I'm going to assume that a year from now they'll be back up to those highs. Well, at what price do I want to buy them in today, tomorrow, in the future, so that a year from now I've had that gain? So is it at 35%? Is it at 45%? What would I be satisfied with as a gain over the next year on the stocks that I'm going to buy? And what wouldn't I be upset about if I bought them at 30% down and they actually went to 40? But still, I believe they'll come past my 30 and I'll end up making 30% on it. So that's what I want you thinking about. What do you want to own, and in what proportions? And the way I do it is say, okay, I'm going to have X dollars to invest. And let's say I want 5 stocks. Make it easy. What percentage of my portfolio do I want each one of those stocks to represent? Now I divide that percentage into the assets that I am willing to invest, and then I divide the amount I'm willing to invest times by their current share price, and I come up with the number of shares I want to buy. Now, if I want to buy 40 shares of X stock, do I want to buy them all at once? Or do I want to buy, what I'm thinking about is maybe 25% of my goal holdings. Do I want to buy 25, and one of them's Amazon. Do I want to buy 25% of the number of shares I ultimately want to own in Amazon now, and then wait another week and see if the market is going down further, and maybe buy another 25% then? And what this is called dollar cost averaging. It protects me from a cure for the virus and everything skyrockets. I get at least part up, and I buy up as it's going up. So that's what I'm doing right now. And that's what I think you should be doing. I guess it is, what should you be doing for your investment portfolio today? And what I think you should be doing for your investment portfolio today is creating a plan. It is essential. Whether you're running a business or you're running an investment portfolio, you've got to have a plan. What you want to avoid is acting upon emotion. Looking at this thing today and say, oh my goodness, it's down 15%. This stock's down 50%. I'm going to buy it. No. That's emotional buying. That's what you get, how you get in trouble. Put together a plan and then set your expectations around that plan, and then take steps to initiate the plan. Again, I'm going to, yet this week, I'm still waiting for Juan to put together the landing page and the autoresponder so that I can share what I'm doing with you sometime later this week. I just hope, I just really hope you've been paying attention for the last year and you're sitting on a pile of cash and you're waking up every morning with a smile on your face. Not that you don't want people to get sick and you don't want people to die and you don't want our economy to get in this mess, but damn it, it's been obvious. I don't know how long ago it was. I told you to look at the debt clock. What is it? USDebtClock.org. It didn't take a genius to figure out we were going down a path of no return, and something was going to initiate this, whether it's a virus or I don't know what. I had no idea, but I knew it was going to happen. And I know what the end result is. It'll come back. I just got to decide, and you got to decide where we're going to buy in. This is wonderful.